You know, when you're buying a home, you need to buy homeowners insurance. A lot of times people don't think about it to the very last second. And then they're trying to figure out, what does the home policy cover? Do I need flood insurance? All these things at the last second. And you know what? It's better to get it up front when we start to write a contract and you're starting the home buying process. That's the time to get insurance. And we're going to be talking to Jeff Brady today. He's going to be covering all those great things. Hey guys, Pastor Donovan, XP Realty, part of the Johnson Group out here in beautiful Savannah, Georgia. I'm in location at Jeff Brady's office from Roundtree Brady with Allstate. And today he's going to be answering about 6 questions about homeowners insurance. I know we did a flood video the other time. I'll tell you what, I think everybody liked that one.
Glad to hear that.
Very thorough. Jeff was amazing. So I thought, hey, if we're just going to talk about flood insurance, why don't we just talk about real homeowners insurance, right? Yep. So we're just going to get into it. And Jeff, before we start, can you just tell everybody a little bit about yourself?
Yeah, sure. Jeff Brady. I'm the principal and CEO of Roundtree Brady Insurance. We're an Allstate agency here in Savannah. Right. I've been in the industry for about 20 years now. Ooh. And looks like there's no turning back at this point.
I think you're locked in.
Yeah, I'd say so.
Okay, so we're just going to get right into it because I don't want to belabor the point here. So I'm going to ask you the first question. Okay, and I think this is what a lot of people want to know initially, right? Is what does the standard homeowners insurance policy cover?
Well, in general, the biggest thing that you're going to find is that sudden and accidental loss.
Okay.
This is not a warranty. It's not a maintenance policy. So your standard coverages you're going to see, you're going to have your wind and hail. You're going to have your theft, fire, vandalism, lightning, power surge, busted pipe, so you have, heaven forbid, a water leak in the house, comes up, damages floors, that sort of thing. Those are going to be kind of your standard coverages that you're going to get with it. You can endorse a policy to get things like water and sewer backup, or maybe you need some higher limits on stuff for like contents. But when you think about a home policy, it's going to cover your structure. It's going to cover your contents.
Okay.
It's going to cover detached structures. So if you have an outbuilding, maybe a pool.
Okay, garage is separate from the house.
Separate garage. Maybe you got a really fancy place and you got a pool house out back.
Oh, yeah.
But then also additional living expenses. So heaven forbid you can't live in your home for 4 months, 6 months, a year. That policy is going to pay for those additional expenses on top of that for you to have somewhere to go to live. And then you have your liability thing. You think about, heaven forbid, a dog bite or something happens at your home. Somebody steps on that kid's toy and breaks their ankle, or trips over a sidewalk and that's
uneven
or got an issue there. Yep, same thing. So in general, though, the biggest key is it's sudden and accidental loss. So it's not something that happens over the course of time.
I think you're bringing up, like, a lot of people use their homeowners insurance to get their roof replaced all the time. I assume that's a big thing for you guys?
It's a real big thing right now because of the frequency and severity of events. And, the big thing you got to remember is that there are, insurers are going to pay for the damage you've got. And you got to think about, is it, if I'm missing 5 shingles, is that really the time that I need to be looking at that? But it's not. If the roof is old, it's just time to get a new roof. That's part of home ownership. Whereas if you've got damage from a hailstorm, or heaven forbid we get a hurricane in the area and you have wind damage, then that's when your policy is going to kick in.
Right. Okay. All right. So are there any exclusions or limitations in a standard homeowner's policy?
Exclusion-wise, again, it's not going to cover rot. So things that happen over time, you'll find standard language says that damage that occurs over the course of weeks, months, and years.
Okay.
All right, so you get that drip claim that comes in, water slowly seeps in, maybe around a bathtub and it damages subfloor, things like that. That's a maintenance issue. That is not considered sudden and accidental. Flood, obviously we've done the flood video in the past, and
if you didn't see our flood video, I'm going to link it above at the end of the video so you can watch it. It is so good. You got to watch it. But all right, go ahead.
But flooding is not a busted pipe, right? So people call me on a sunny day like today and say, "Hey, man, I've got to flood my house," and like, where is that coming from?
But
the reality is, we're talking about surface level water, and our area It's going to be, riverine. It's going to be around rivers that maybe get a lot of water from rain, or heaven forbid we get a hurricane and we get surge. So you got to have a flood policy to cover that. Other limitations in policies on your content side, most standard policies are going to have limitations for theft on certain things like jewelry. Jewelry is the big one that we see. Policy may have anywhere from $2,500 to $5,000 in jewelry coverage, which includes watches as well. But those things, if you have a greater need, you can endorse the policy and get more.
Okay, so with that, okay, I'm gonna go crazy. I don't have one of these. Well, actually, I do have some. So me and my wife, we got lucky. So when I was, I think my son, he wasn't even born yet. My son's 17 right now. So we went downtown. My wife was super pregnant with my son. We go looking in an art gallery. Mm-hmm. Okay, and his name is Vincent Goldani. Golden Palace. He has a shop downtown still to this day. And we went in there and we started talking to him. We didn't know who he was, and he happens to be the artist. And we told him, hey, I'm going to Iraq. We're about to have our son. And he's like, do you like want any of the paintings? And we were like, we would love it. We don't think we can afford it, but we would love it. And so he's like, I tell you what, you name your price, and as long as it covers the paint and the canvas, I'll give it to you.
Wow.
I'm like, so we didn't have a ton of money at the time. So we're like, the most I'd give you is $250. So he gave us the painting. We go online to look at the same painting. You know how much that painting cost?
No telling.
$40,000 he was selling.
Wow.
$40,000. So in that case, I have a $40,000 painting.
Mm-hmm.
So is that something I have to get appraised and then up the coverage, or how does that work?
Yeah, so contents in general is most policies, and this is one thing you want to make sure you have, is replacement cost on your contents, okay? Mm-hmm. Now, how that works is they're going to pay you the value of it, actual cash value of it. So if you're talking about a chair or a table or something mm-hmm. that you can go pick up at a store somewhere, they're going to pay you that. When you replace the item, they make up the difference. Okay. So if you've got heaven forbid, lightning strikes and you have electronics, a couple of TVs, a computer gets fried, at the end of the day, they're going to make you whole minus your deductible. Okay. When it comes to things like jewelry, watches, fine arts, antique furnishings, they've got to be treated with an appraisal. Okay. Right? The reality is that because it's replacement cost, if I can't go out and get that painting, because it's, even if it's a limited series and you've got, let's say, 50 or 100, right. If you've got number one, and number one is damaged, you can't get another number one. Right, yeah. So the only way to get value out of that is to specifically schedule it under your policy. Now, there are different ways you can go about covering things like firearms. Some people don't like to disclose what they have. Oh, which I get 100%. And this can be expensive. Very much so. I've got clients that shoot out the gun club, and they've got $25,000 shotguns. That's outside of my range. But right, sure. Absolutely. Wow. But in those cases, many times what we'll do is we'll advise them to go purchase a blanket policy through a national association such as NRA or... Oh, they have insurance policy? Yeah, you can get specialty things for that. And the same thing with jewelry, whether you're writing through adding it as an endorsement to your existing policy or buying it separately, you can schedule items for their value. A lot of times we'll find, an engagement ring or a wedding set that somebody has. Mm-hmm. And when you schedule that item, especially if it's jewelry... What do you mean by schedule? Scheduling meaning I get the appraisal. I'm going to actually endorse the policy with a description of the item and set a value for it. So if it's a $5,000 ring, then I've now added it at $5,000 value to my policy. And it's also going to give me some broader protection. So heaven forbid you look down and that diamond has fallen out. Right. That's not a normal coverage. Oops, I lost it. But we call it mysterious disappearance. So that just means that I probably got a half a dozen clients right now that have a diamond somewhere in their home, and it just got caught on something and the prong broke. Oh yeah, no, that happened to my wife. I actually just got it fixed for her. It was an engagement ring from her grandmother. So I know how that happens. Yeah, so those are the things. So those are some of the little things that we see on the content side. When you're talking about, how do you protect yourself, mm-hmm. especially whether it's a fire or a hurricane. One thing that I recommend that you do. Everybody's got a cell phone today, right? It's got a camera on it. You can video something. Walk through your home after you've moved in. Take some pictures. Oh, that's great advice. Do a video. Email it to yourself, right? Because now it's out there and wherever. It's date stamps. It's got everything, but it serves two purposes for you. First off, it's going to remind you what you have. Because heaven forbid you have a fire, the first thing the insurance company is going to do is send you this Excel spreadsheet and say, hey, guess what?
Fill it out.
Fill it out. We don't know what you had.
Right.
You know, so from that point, hey, if you had the $10,000 bison leather sofa, and, you know, people may question that, but if you've got proof that you had it, that at the end of the day, that's how you have your protection. It serves two purposes. It's proof, and it also jogs that memory. So you know, man, I forgot I had this, or whatever it may be. But also don't keep it on your phone. Your phone may get damaged.
Yeah.
Everybody puts it to the cloud. The beauty of that is you can access it anywhere.
Yeah, no, that's smart. See, in the Army, when we were moving, they would say, hey, videotape your stuff so that when you have to claim damage when you're moving, during a PCS move, you have the proof of it. So yeah, no, that's awesome. Well, thank you for that. That's awesome. It's not that you hear all these things over the years, you forget it over time. That's why Jeff's here to remind us of those types of things, right? Okay, so how is the replacement cost of my home determined?
Yeah, so we get this question all the time from people, and somebody will pay for a home, and keep in mind that insurance covers the structure, right? So you may pay X dollars for a piece of property, but what does that include? Land.
Yeah.
Right? We're not insuring dirt.
Yeah.
Right? So the location of the property may have so much to do with the value. But most companies are going to use some sort of cost calculator. In many cases, if you look at a company like CoreLogic, they are probably the biggest data warehouser when it comes to property in the country.
Right, that makes sense. They run our MLS.
Oh, there you go. So
the matrix. Yeah.
With that information, though, they have a cost calculator that we use that we actually build out replacement values. Okay. So we're putting the components in. So when you're getting a homeowner's insurance policy, when that gets in place, part of that policy is actually going to be the details that were used to determine your replacement value. So it's going to say whether it's a custom kitchen, semi-custom, builder's grade. Do you have 8-foot ceilings? Are they 10? Is it heart pine or is it LVP? All of those things go into it, and it's a roadmap. It's designed to get us to a point, and keep in mind it is a estimator, right? It's not an exact. It's an estimate.
So let me ask you this. You guys do your cost estimator, so we're talking about that, right? If you get the contractor out there, they say, hey, this is how much it's going to cost to build the house, and it's outside of that cost estimator. Will you, even though I pay my deductible, are you guys going to still cover it, even though it's outside the cost estimator?
So there's a few ways you can protect yourself with that. First off, it is an estimate, right? And so too many people make the mistake of just saying, hey, I've got, let's just use a $250,000 replacement value. Okay. So I got $250 in coverage. Well, again, that estimator is a snapshot in time.
Okay.
So we run that today. Okay. And that's the minimum replacement value. Now I can increase coverage above that if I need to. I just can't go below it. I have to insure it to 100% of the estimated replacement value of the home. Now, we want to make sure that our estimate is correct, so that's why it's extremely important to know that the inputs going into that estimate are accurate. I can manipulate it. I can say you got a custom kitchen. I can say you have a builder's grade kitchen. That's going to influence what that replacement.
Because there's a standard for those types of.
Correct, and it's you think about it. A semi-custom kitchen is probably going to have prefab boxes. You may have some custom doors or some handles or things like that. When you start getting into custom and designer kitchens, it's going to be specialty appliances. It's going to be a lot of built-ins.
Right. Custom cabinets.
Yeah, custom cabinets.
Woodworking.
Absolutely. You're going to have all kinds of moldings and other things. Generally, it's going to be some sort of solid surface countertop. Right. Like I said, you're going to have, and it even gets down to the point, are they soft closed drawers? As opposed to, those hinges and things like that. That's where your cost comes in. Okay. Sheetrock's cheap.
Right.
Sheetrock is cheap. So at the end of the day, though, if you've got custom cabinets and you've got those soft closed doors and you've got specialty appliances, maybe you got a wet bar. Maybe it's 12-foot ceilings in certain areas, heavy molding. All that stuff. That's where it gets really, really expensive. And so, even on new construction, you got to think a builder is getting value in volume. Right. So from an insurance standpoint, we have to consider things based on one-shot construction. It costs more to build a house one-off. It just does. And the same thing with repairs. So when you consider it, one of the biggest factors that I look at
Right.
is that I want to make sure you've got two main coverages on top of whatever your standard is.
Okay.
So first off, because it's an estimate and it's a snapshot in time, what happens if we have these inflationary issues that we've had?
Yeah.
And in 6 months, it costs 10% more to build your house.
Right.
Well, what if I'm at 250 and I need 275?
Okay.
So, I mean,
Well, how do you combat that?
Well, there's a couple things. And other factors, too, is that you also have things like this. So I had a client after Hurricane Matthew that had 6 pine trees on their house. Mm-hmm. It costs...
On their house?
On their house.
Oh, my goodness.
It cost
Wow.
$40,000 to get the trees off the house. It was $8,500 just to get the crane to show up.
Holy
just
cow.
to get there.
Wow.
So think about it this way. You burn through $40,000 in your building coverage. Are you going to have enough coverage to be able to actually repair your home?
No.
So there are extended limits protections that you can buy over and above. So we'll use a $300,000 home. So companies will have anywhere from 10, 20, 25, 40, or even 50% over and above. So if I've got a $300,000 house and I've got that 120% extended limits, I've really got $360,000 in coverage.
And that will cover your inflation
So
costs.
now it's going to give me that extra. It's like overdraft protection you don't have to pay back. It's there just in case.
Wow.
So it's extremely important to combat those mitigation issues, demolition costs, debris removal, inflationary pressures that you may see. That's extremely important. And people will cut that out.
Well, because they're trying to save money monthly, because a lot of times, you're paying, especially in this inflationary time where you're talking about, rates are high, cost, the home prices have risen just astronomically, even since I've been doing real estate. Oh my God, they're almost
amazing.
Double. Actually, in a lot of times it is actually double, you know what I'm saying? So so on that same vein then, how often should they reevaluate with you their policy?
Well, so the nice thing is that your major insurers, okay, and to me, I'm biased, but there's a reason why you want to go with a good, reputable, A-rated insurer, because they're going to actually reapply that cost calculator each year.
Okay.
So for example, if I have $300,000 this year, and my renewal is coming up,
okay,
the system's going to automatically apply all those inputs that I've used and put them back into the calculator, and that's going to reevaluate. It's called a property index adjustment.
Okay, so I got that. All right, that makes sense.
Yeah, so let's say I'm just going to use 10% for easy math. So let's say it costs 10% more this year than it did last year to build a house because of labor costs, because of material costs, whatever it may be.
Okay.
So my renewal is going to come around, and my $300,000 in coverage is going to go to $330,000.
Okay.
All right. Yes, my rate is going to go up, but I have more protection because I need more protection, and the insurer, based on the insuring agreement, is required to insure it to a minimum of 100% of the replacement value. So that's where it's important to make sure that roadmap is correct, and that's what that cost calculator is. It is a roadmap to get to the final number. It doesn't influence what happens in a claim.
Okay.
So if it's incorrect and it's a $100,000 loss, it's not like, you said you had a builder's grade kitchen and this is semi-custom. No, they're still going to put a semi-custom kitchen back in there. It's just, if you have a major loss, let's say a total loss,
right,
are you going to be sufficiently protected for that?
Okay. Yeah, so you're saying this is more pertaining to total loss. If my house burned down, how do I build it to the same level it was before?
Correct, and it happens. Unfortunately, I've been standing there when with fire chief as they're putting out hot spots on a home. It's pretty brutal to see. I mean, they're devastating. But that's
do you normally go out there when your clients have a fire or something like that?
I try to if I can.
Yeah.
I've walked back in this office smelling like smoke after standing in somebody's home and telling them it's going to be okay. I've been out after Hurricane Matthew. I was actually out on location with a client on Isle of Hope that had a pine tree in her second floor, and I was standing there in her bedroom looking at a pine tree.
Wow.
I was there with claims, but they had asked me to be out there with them for some other things. But if we can, we try to go. It's just simply because water loss, there's not much I can do.
Right.
But from a fire standpoint, I had one client that I was standing in their driveway with 2 Chick-fil-A biscuits and 2 cups of coffee and just telling them, hey, we're going to make sure it's okay.
Well, that's good.
You know, and that's just part of it.
Especially when you're going through a hard time like that, it's good to have someone there to reassure you, because I can't imagine. I've never gone through that, so I can't imagine what that's like. And having someone there to tell you it's going to be all right is probably huge. So that's awesome.
Yeah.
All right. Okay. Well, great. Okay. So next question. This is just something I've heard. So I hear there's a lot of insurance companies kind of backing away from the Savannah area because of the hurricanes and all that stuff. Is that true?
Well, I can tell you that companies have definitely tightened up. The biggest issue that we're facing right now is the frequency and severity of events.
Okay.
So whether it's wind and hail, yes, we've had some impacts from some storms in the last 7-8 years, but the reality is that we're just seeing more severe weather, and couple that with the fact that it costs so much more for each claim. So average claim cost has gone up, and then the frequency of claims has gone up as well. So what does that mean? Well, insurers have 2 risk management levers, if you will, that they can pull. The first one is rate. Mm-hmm. All right, so they say, well, if we're paying out $1.20 for every dollar that's coming in the door, we're losing money.
Right.
So we've got to manage that some way, shape, or form. So you go to the insurance commissioner and you say, hey, I want X rate. So let's assume they get it. That's all the action they have to take. In many cases, though, they're not able to get the rate they want. So what happens is companies don't want what we call adverse selection. All right. Now that just means they're getting bad risk at inadequate pricing.
Right. Okay.
So that's what we're starting to see more of as companies are tightening up. Whether it's an older home, tighter restrictions or tighter guidelines on older properties.
Right.
I hate to say it, older homes have a higher claims frequency.
Well, of course, yeah.
Could be based on location.
Mm-hmm, mm-hmm.
And it could be a number of factors. I know we're going to talk about like credit and that sort of stuff, but those things are all driving it. So companies are really trying to say, we want to take this, not all of this.
Right.
And every company's got their own appetite.
So kind of just pick and choose. I don't say pick and choose. I don't want to make it sound like that, but maybe eliminate higher risk properties from your portfolio, and maybe someone else has to cover.
Well, and it's not only higher risk properties. It's, I hate to say it, but higher risk individuals.
Oh, okay.
Because you could take the same home with 2 different applicants, and they can one of them could be ineligible. And one of them could, or if they're both eligible, one of them could see a vastly different rate. It could be extremely higher, much higher, because of credit, claims history, things like that.
So when you're going to get homeowners insurance, they're checking your credit score?
It's not really a credit score. Most companies have some sort of algorithm, and they have their own. It's like the Coke recipe. They don't want to know. They don't want it to get out on how they're assessing risk.
Each company has their own.
Each company has their own, but you're going to see 90+% of insurers now use credit at some level to determine rate and eligibility.
Well, you're telling me also they're looking at people's driving records, right?
I mean, that's in some cases yes, but it's really a matter of it's measuring financial responsibility across the board.
Or just responsibility.
Responsibility in general.
Because if you're going to be speeding around the road and crashing into things, and I get that.
But it's amazing to see what all goes into not only eligibility, meaning just sometimes it's just yes or no. They'll offer it or they won't.
Right.
And that could be things like claims history. If you've got multiple claims out there, it's going to be really, really difficult to be able to get insurance on a home.
Right. So who regulates the insurance company? Because I think that's a lot of people don't understand. Actually, to be honest, before we talked this morning, I really wasn't sure. So who regulates the insurance company and the rates?
So each state, rates are, and insurance is regulated on a state-by-state basis.
Okay.
So there is no federal thing like FINRA on the financial side when it comes to stocks and bonds and that sort of stuff.
Okay.
So it's done on a state-by-state basis. John King is the current insurance commissioner for the state of Georgia.
Okay.
So Department of Insurance, it's fire and safety commissioner as well. But from an insurance standpoint, they're going to regulate not only the coverages that are available.
Okay.
So the policy forms have to be approved, but the actual rates themselves, the cost of insurance, is regulated by the state. And so in Georgia, we have what's called a file and wait system. So that means that if an insurer needs to take a rate, they're going to file that rate with all the supporting documentation. The insurance commissioner's office is at that point going to review it.
Not for each individual policy.
No, it's for each company.
So your company says this is what we need to do what we do, and you file that as a whole.
As a whole, correct.
Okay.
And it's so they have rules and rates. Is basically the rules are how they're going to do business. Okay. Meaning, when a surcharge is applied, when a discount is applied, what the deductibles are going to be, and it's all kind of tables and things that come with that. The rates themselves are the actual cost per, dollar of coverage that is going to be applied. Okay. And those rules and rates coincide in the sense that the rule is that if you've been claimed, this is just making something up, but let's say claim free in 3 years, then you're now eligible for the discount. The rate is what that discount actually is as it's applied to the base rates that are in that. So,
okay, so I think I understand. So what you're saying is that you come up with Roundtree Brady, for instance. Let me just.
No, we don't set rate at all.
Okay, no, what I'm saying, the policy is set by Allstate.
So in that case, Allstate, or whether it's Nationwide or whomever, the insurance company itself will actually file those rates with the DOI. Us as agents have zero control over rate. Zero. I want to be very clear about that.
You're just applying what the higher echelon has already set in place.
Correct. My role in this whole thing is to make sure that if I have a prospective client, first off, we're going to make sure they have appropriate coverage based on what I can offer. Right, all right. Okay, so we want to make sure they're adequately protected. They understand all the coverages that are available to them because some of them are optional. You can choose to purchase additional protections. Right. And that they are getting all the discounts available to them. Like, that's my role within the machine, is to make sure they understand that when it comes to writing policies.
So you could guide prospective policy owners, you could guide them in a way, maybe during their renewal, maybe if you do this, you could get the discounts. Is that what you're kind of saying?
Yeah, so we're going to make sure from the start they're getting everything they're eligible for. Now, there may be things initially that they aren't eligible for. It could be based on the age of their roof. It could be they don't have a security system in their home. Maybe, let's see, I'm trying to think of some of the other things that...
And how do dogs factor in? Like, if you have one dog, like...
It depends
they help
on the
with your insurance?
Dog bites are actually the number one liability claim in America.
Really?
Yes. When it comes to homeowners insurance, dog bites are the biggest thing. So you'll find some companies, depending on the breed of the dog, could be an issue. Some companies, it doesn't mean a hill of beans to them. They've just they've got it priced in a certain level, and that's just what it is.
And that's the policy of the overall arching.
Correct. Each insurer is going to set. They're going to set.
So they
their
say
guidelines.
Anything over 2 dogs, we're not insuring. That's the policy you have to go over.
Not necessarily. I don't normally see that. It's typically, when it comes to dogs, they don't care if you've got 2, 10, or 100.
Really?
They're just more concerned about what kind you have.
Okay.
So breed is the bigger issue, and in some cases, many times we have to answer the question on the application: do you have a dog? Yes. Do they have a bite history? And because that's a quick way to to get that X and for them to say no. But again, it depends on the insurer about whether or not they're going to ask that question.
So, how could you, like, if I said, okay, I'm just going to give you a scenario. What if I said I don't have a dog and I have a dog?
Well, if you lie, it's misrepresentation on an application.
So is that like insurance fraud?
I wouldn't. You're borderline, but the reality is, if you misrepresent yourself on an application, it's like any contract, because that's what this is. It's a contract.
Right.
You can void said contract.
Okay.
So if you say, well, it's kind of like with life insurance. You say, no, I don't smoke.
Right.
And then
they send the blood work people out to you, so there's no getting around it.
They're going to get that for sure. But the reality is, like, you lie about the age of your roof, number of occupants, if you have a dog, various things you can misrepresent yourself, and then something happens, and they determine that, well, wait a minute, you do have a dog. You did have a dog when you applied for it. They could deny that claim. Now it falls back on the individual, and they could be, maybe they're getting sued over something.
Wow. Yeah. So, okay. All right, let me ask you this question, since it's just rolling kind of into it. If, for instance, I got a home, didn't have a dog. I get a dog, do I need to tell you?
Wouldn't hurt.
Okay.
It wouldn't hurt. I live in a world where it's easier to ask for permission than forgiveness.
Okay.
Because the reality is that if you are, I mean, it's even a situation of if you renovate your home.
Yeah.
We want to know because we want to make sure that you have appropriate coverage in place. The same thing as if you had a pool. Do you have a fence? Maybe you've expanded your home and life has gotten good and you've built up a lot of assets. Maybe you pay your house off.
Right.
And now we're thinking about liability protection. Those sorts of things, you don't want to put yourself at risk. That's what insurance is there for, is to protect you.
Right. It's not there to just add more money onto your monthly payment, which I think a lot of times that's what everybody's trying to reduce, right? Their monthly payment, but then we neglect the other parts, which is huge. If you get a fire and it burns your entire house down and you don't have enough coverage to cover it, who's covering it?
You are.
The individual, right?
It falls back to the individual. It's like with flood insurance. People say, oh, well, FEMA will just come in. No, they'll come in all right, but then they may give you a couple grand. But then if you're really building things back.
Well, that was an interest-free loan, or it was a lower interest rate loan. So having adequate coverage is super important. Jeff, I really appreciate you talking about all these things.
Yeah.
Did I miss something?
Well, I think the biggest thing, the last thing that we really wanted to kind of touch on is how can you as an applicant for insurance make yourself more attractive to an insurance company?
Oh, okay.
I think that's really important to know, like the biggest factors that are going to go into, not only eligibility, but also your pricing.
Okay.
All right. So, I mentioned a little bit about claims. If you've had, in some cases, just one claim in the last 5 years, some insurers are just saying, no, sorry, we're just not interested. That it's just, again, back to that tightening of things up.
Right.
If you've had multiple claims, and you got to be careful about filing claims. I can't tell somebody not to, but whether we agree with it or not, if you're filing a bunch of little claims, that goes back to that financial dependency. And claims aren't based on severity. I think this is a misconception in what we deal with, is that, if you've had $100,000 fire and you've had 3 $2,000 water losses, guess who we're going to take?
The fire.
The fire. We're going to take the fire because it's one claim.
The water is also could be maintenance-based.
Could be maintenance-based. It also comes back to that dependency. I mean, there's a lot of things that goes into it. Your credit is a huge, huge impact of what you pay. Huge impact for what you pay. The better your credit is, just like an interest rate on a car loan, the better your rate's going to be.
Right.
Age of home, new homes, we love new homes.
Of course.
New roof, new plumbing, new electrical, new everything. They just have fewer claims.
Right.
Whereas, conversely, an older home is going to, whether we like it or not, the frequency of claims on older homes is there. So you're going to pay more. Location. Are you buying on Tybee?
Right.
Are you buying inland? Those are going to influence not only your deductibles, so we've talked about in the past, like named storm deductibles or wind and hail.
Right, yep.
Those are those higher deductibles. The closer you are to the coast, you're going to end up taking on more risk for that.
The price of living close to the water.
Right.
I mean, when you're moving close to the water, there's more risk.
Exactly. When you're dealing with that occupancy, is it owner occupied? Is it tenant occupied?
Yeah.
Is it an STVR? All of those things need to match up as well. And that too many times we see that somebody will own a home, they'll move out.
Yeah.
Then maybe they buy another home. They still got a homeowner policy on this, which is owner occupied.
Right.
It doesn't have their lost income coverage. Maybe it doesn't have appropriate liability. That needs to be rewritten. Needs to be rated based on the occupancy. So those factors. Age of roof. A new roof is going to give you much better rate.
Yep.
Obviously, your claims history, your credit history. Are you bundling? Biggest discounts you can get out there, you tie your auto and home together. And
so you recommend bundling?
I mean, if you can. I mean, I understand there are circumstances where, for whatever reason, maybe they had an accident or two and maybe they're not competitive on the auto.
Okay.
But the reality is that in a lot of cases, the discounts on auto and home when you pull them together is really big. I love first-time home buyers. One of the reasons why is that when you go from a renter to an owner,
you're really taken care of.
Then what happens is that now you're, from an auto standpoint, I know we're talking about home, but from an auto standpoint, you're magically a better driver. And you say, well, what do you mean? Well, you're changing demographics. So going from a renter to an owner, you change over. And so a lot of cases, we'll get somebody who's renting, and we're able to quote the auto for them. So we can get that big discount on the home. And not only are they going to get the multi-policy on the auto, now they go from renter to an owner. It's like a double discount.
Oh wow! It's like when you turn 25.
Yeah, it's kind of like that. So which is really, really nice. But credit, location, age of home, your claims history, age of roof, updates, occupancy. Those are going to be some of the biggest factors that come into it. And I'll tell you this, for any of you folks out there that are thinking about becoming a homeowner, go ahead and get some renter's insurance. All right, and you say, well, why in the world would I, if you don't have it now, get renter's insurance, because it's like having that first credit card.
Right,
you think about
to build your credit.
Building credit.
Yeah,
the same thing
yeah.
works with renter's insurance is that when we go into the application, it asks, do you have prior? Well, if they've just been hanging out.
That's a different category.
Yeah, so it's an additional discount. In some cases, it can be 10 to 15%. So it's like building credit. You now have a history. Because you've had renter's insurance, especially if you haven't had a claim.
Yeah.
Now it's kind of like having that prior credit card, so you're building things
that
up.
makes a lot of sense.
That's one of those little tricks that you can get. And to be quite honest with you, in most cases, if you've got car insurance, having a renter's policy with it's probably going to pay for itself.
Oh, there you go. Okay.
Just from a discount standpoint, we see it all the time. And it's actually cheaper.
Oh wow. Okay.
Yeah.
Well, that's smart. That's smart. Well, Jeff, I really appreciate your time on this one. You answered a lot of questions that I learned some stuff today. Once again, if you didn't see my flood video with Jeff, he's very thorough, and we're going to link it right here above. So just click on that and go right over. And I really appreciate you guys watching. I'll talk to you guys soon. Bye.